The Federal Reserve is widely expected to cut its main interest rate this week for a third time in a row. Also on the agenda this week is the US third quarter GDP figures and the latest monthly non-farm payrolls report. So what should we expect and how do we trade these events? Daniel Lacalle is the chief economist at Tressis and is here to help us answer those questions. Daniel, good to see us.
Thank you very much.
Let's start with the Fed because we are expecting this third cut. But Powell has framed this as a mid-cycle adjustment. So is this enough?
Well, I think it's unnecessary. I don't think that the US economy needs another rate cut. And judging by the messages about the strength of the economy that Mr. Powell gives and judging by the data, I don't think that there's any need for a rate cut. However, I think that the Federal Reserve is acting preemptively and is acting also as a reaction to a much more dovish European Central Bank, much more dovish Central Bank of China, People's Bank of China, and the BOJ. So it is very likely that he will give both messages. He will talk about the strength of the economy, the strength of the labor market, and the decent inflation data, and at the same time probably give a rate cut. So it's this new concept of hawkish, dovish Fed that we're hearing quite a bit recently.
So you do think we are going to get this rate cut? There's no chance that we won't, because it seems as though the sentiment has really shifted around the world recently. I mean, if we look at Brexit, that's one risk that seems to be subsiding a bit. Also the trade tensions, everyone's growing in optimism towards that issue as well.
Yeah, well, I would agree that if we look at, on one side, the risks that have been perceived by markets and the way that markets have behaved, added to the macro data itself in the United States. You saw the manufacturing index in expansion, services index in expansion, also quite good. The jobless claims was actually better than expected. Inflation remains above the 2% core inflation, 2% level. Therefore, none of the data in the United States is justifying a rate cut. However, it does look very much like the Fed does not want to be strengthening the dollar for no purpose, and that therefore a rate cut is more a reaction to an incredibly and misguidedly dovish ECB, in my opinion, rather than what is happening in the United States economy.
So we're going to get this rate cut, but what happens next with rates? What does the Fed do next? Does it just stay on hold for a period of time, and how long could that be?
Well, what I would think would be the right thing to do would be to remain closer to the curve than the Fed is right now. And likely also, considering what we have seen in the repo market and the challenges of liquidity that we see in the US economy, is to stick to addressing those issues rather than just cutting rates for no reason, particularly when there's no need. No? So however, it does look like the Fed wants to look like it's not hawkish relative to other central banks. This is all relative, obviously, because it is not being hawkish. But I think that what the Fed should do should be to address the liquidity issues of the repo market, but do it with a very clear time frame so that it does not become a hidden QE. Second is to maintain rates closer to the curve, and second is to pay a lot more attention to the risk of bubbles in the financial market.
So on the financial markets, obviously in terms of the US dollar, we've had this massive bull run really since the start of 2018. We've seen a little bit of a pullback recently. You alluded to the fact that the Fed doesn't want to strengthen the dollar for no reason. I mean, where do you stand on the outlook for the greenback? Do you think it's got more room to run?
I think it has. And the reason why I think it has more room to run is because we have massive maturities coming from emerging markets in US dollar denominated debt, added to a weakening level of reserves, as well as weakening dollar revenues from commodity sales. So that in itself creates a larger demand for dollars than probably many have in their minds. Additionally, the extremely dovish attitude and policy of the ECB, of the European Central Bank, is also in essence a call to buy dollars. So I think that as the growth in the economy, in the global economy, starts to reflect the reality of at least stagnation that we see in some economies, and we see as well that there's a rising demand for dollars from emerging markets, then I would continue to be quite happy with a strong dollar relative. Again, we're talking the DXY here. DXY index is clearly showing that it's not necessarily that the dollar is strong, is that the rest of the currencies are weak. And what we are seeing in emerging markets in Latin America is pretty evident, and we should pay a lot of attention to that growing demand for dollars from the massive maturities in US dollar denominated debt, both at the public and private sector.
What about the US equity market? Because it's been interesting to see that it's hit a fresh record high, once again back to those highs not seen since July. I mean, we know it's an election year next year that's kind of notoriously strong when it comes to the equity market. Some of those risks are subsiding as well. Do you remain bullish?
I think that relative to the rest of the equity markets, I remain bullish. Not just because of the dollar strength, which helps the US equities, but as well because of buybacks. It's the big difference. It's the fundamental difference between the US market and the rest of the equity markets. So with a level of growth in earnings that is quite acceptable, actually, and even in the guidance so far seems pretty okay. But with that growth in earnings, even if it's not particularly anything to write home about, but relative to the Eurozone, relative to the European market, relative to emerging markets, that is the reason. So again, on a relative basis, I think that the US on buyback on the companies that do significant buybacks, plus companies that are more exposed to the domestic economy. Remember that the S&P 500 is an index that exports very little. Doesn't even get to 38% of its earnings. Not a problem. So a strong dollar is actually more helpful than in a global slowdown than the alleged benefits of exporting a little bit more. No, the US exports very little. So I think that being selective is also good, but I still think that if you look sector by sector, the United States equities do not look more expensive than their counterparts in the Eurozone or in emerging markets. So
if we are looking at US sectors, then where do you think the opportunities are?
I think that everything that has to do with communication technology, I really think that also the part that you need to look at that has been less attractive, so the utilities / infrastructure, etc., has been less attractive compared to the big tech. Not that they have done badly at all. And I also think that sectors like defense, very, very good sector, actually. And I think that very unloved. So quite interesting also in terms of margins and in terms of earnings growth. In the energy sector, you start to have really interesting opportunities in companies that are more in the climate change / renewable space. These have been, some of them actually have done quite poorly because of the risks perceived of changes in legislation, etc. So, relative again, I think that you have a few sectors that look good.
So a lot of your kind of rationale behind investing in the US, whether it be in the equity space or within the dollar, appears to be kind of a relative trade.
Yeah.
The rest of the world is slowing down and the US looks relatively attractive. If we try and look at the US economy in isolation, though, what's your kind of temperature on the strength there? Because we've got a few pieces of data coming up this week. US GDP for the third quarter is expected to slow. The NFPs are expected to slow as well. Does that cause you concern?
Well, obviously we're in a late cycle period. We've had the largest expansion in the US history, and we cannot expect those levels of growth and those levels of job creation to continue. However, I think that what continues to surprise on the positive side is the fact that, yes, the data is slowing, yet compared to other economies, it is doing a lot better. And I think that that is the key factor, is that all of us that analyze the US economy get very, very, very negative very quickly because, you know, the job creation instead of being 230,000 people was 200. Oh my God, it's a disaster. When you have unemployment rising in other places, when you have, you see what I mean? So again, we need to look at the US economy from what it is, late cycle, sorry. Doing better, you know, manufacturing index in expansion, services index in expansion, still creating jobs, jobless claims still good. So again, nothing to be terribly excited about, but on a relative basis, great that the economy doesn't export a lot, very important factor in a global slowdown. Second, the huge importance of the U.S. economy of being almost energy self-sufficient, and being energy self-sufficient is the biggest stimulus. You don't need rate cuts. You don't need QEs. You need to be, you know, self-sufficient on energy and not export a lot and have a tremendous market already inside that more than offsets the weakness of other economies. Therefore, again, relative, not trying to be here hugely bullish on the United States. But if I have to look at the challenges of all the other economies, all of the major economies, do I want to be in China that has been slowing down for it? No, I don't. Do I want to be in the Eurozone? Well, the Eurozone is very stable as in stagnation. So, you know, do I prefer the United States? I do, yeah.
Daniel, thank you very much.
Thank you, always a pleasure.
That was Daniel Lacalle, Chief Economist at Tressis. I'm Victoria Scholar, and thanks for watching IGTV.